The current geopolitical rupture was catalyzed by the unprecedented executive actions taken in Washington, abruptly levying a 25% blanket import tax on all goods originating from the United States' immediate neighbors, compounded by secondary tariffs targeting Asian trade routes. While the administration's official press briefings anchored these policies in the rhetoric of border sovereignty and domestic industrial revival, macroeconomic historians immediately recognized a darker parallel. This was not merely a modern iteration of the 1930s tariff wars. The sheer scale of the disruption closely mirrored the sudden paralyzing impact of the 1973 OPEC embargo, mixed with the fiat currency chaos of the 1971 Nixon shock. The administration had miscalculated the asymmetry of modern global trade, inadvertently setting the stage for a catastrophic and prolonged contraction of the North American economy. The theoretical risks of protectionism became visceral reality at exactly 9:15 a.m. Eastern Time. Following an emergency broadcast from Ottawa outlining a devastating asymmetric retaliation strategy, global financial markets experienced a violent liquidity vacuum. Within a mere 45 minutes of the opening bell, equities, automated trading algorithms triggered a cascading sell-off, forcing the S&P 500 to plummet past the 7% threshold, immediately tripping level 1 market-wide circuit breakers and halting trading across all U.S. exchanges. Volatility, the CBOE Volatility Index, VYX, Wall Street's primary fear gauge, spiked by an astonishing 52%, a velocity unseen since the apex of the 2020 pandemic crash. Currency dynamics, the US dollar index, DXY, suffered a brutal contraction, shedding value against the euro, the yen, and most notably, the Canadian dollar, as institutional capital fled American exposure. The core of Ottawa's response was not a series of petty reciprocal tariffs. Instead, the Canadian leadership unveiled a sweeping $850 billion legislative leviathan designed to permanently dismantle U.S. economic hegemony over the continent. This framework was engineered with a singular, ruthless objective: to completely restructure global supply chains, rendering any future U.S. trade hostility statistically and mathematically self-destructive. Pillar 1. The weaponization of corporate fiduciary duty, $350 billion allocation. Rather than penalizing U.S. companies, the first pillar of the strategy sought to seduce them. Ottawa initiated a massive $350 billion capital arbitrage initiative to induce a systemic corporate inversion, a mass exodus of Fortune 500 headquarters across the northern border. This maneuver ruthlessly exploits the foundational laws of U.S. corporate governance. Under established legal doctrines, a board of directors is bound by a strict fiduciary mandate to maximize shareholder value. Ottawa's package offers a 0% corporate tax holiday for over a decade, complemented by aggressive per-employee relocation subsidies and guaranteed, tariff-free entry to the European Union via the Comprehensive Economic and Trade Agreement, CETA. When a major tech conglomerate, currently facing an effective U.S. federal and state tax burden north of 25%, is presented with a legally sound pathway to slash its tax liabilities to zero while maintaining global market access, relocation is no longer a matter of corporate patriotism. It becomes an unavoidable mathematical imperative. Any board refusing such an offer would face immediate hostile takeovers or crippling derivative lawsuits from activist hedge funds. The policy effectively drafts Wall Street's own greed into the service of Canadian economic sovereignty. Pillar 2. The commodity chokehold, $200 billion allocation. Petrochemical vulnerability. The United States imports roughly 4 million barrels of Canadian crude daily. More critically, the vast U.S. Gulf Coast refining complex is chemically and mechanically engineered specifically to process the heavy, high-sulfur sour crude extracted from Alberta. These multi-billion-dollar facilities cannot simply pivot to processing light-sweet crude from Texas without suffering catastrophic drops in yield and severe equipment degradation. By bottlenecking this heavy crude, Ottawa effectively strands American refining capacity, guaranteeing domestic fuel shortages and price spikes. Agricultural collapse. The U.S. Corn Belt, the bedrock of global food security, requires massive inputs of NPK fertilizers. Canada controls the lion's share of the global potash market. By restricting these specific mineral exports, the U.S. agricultural sector is forced to seek alternatives from heavily sanctioned geopolitical adversaries in Eastern Europe. The resulting friction inevitably triggers violent spikes in domestic food inflation. Grid dependency. Critical regions like New England and New York rely heavily on high-voltage direct current, HVDC, transmission lines importing massive loads of hydroelectric power from Quebec. Altering these export quotas instantly threatens regional U.S. power grids with peak demand brownouts. Pillar 3. The logistical pivot. $300 billion allocation. To ensure this leverage is permanent, the framework allocates massive sovereign wealth to bypass U.S. logistics entirely. The goal is to aggressively reduce Canada's historical export reliance on the United States from its traditional 75% down to a mathematically safe minority share within half a decade. Capital is flooding into deep-water maritime infrastructure. The port of Prince Rupert in British Columbia is undergoing hyper-expansion to streamline direct bulk shipping to the Indo-Pacific, cutting transit times to Asia by days compared to U.S. West Coast ports. Simultaneously, billions are earmarked for reinforced Arctic shipping lanes and modernized Atlantic terminals in Nova Scotia, creating an unbreakable, high-volume trade bridge directly to the European continent. By rerouting physical commodities around the United States, North America is geographically rewritten. Detroit, Chicago, and Buffalo lose their status as essential transcontinental hubs. This geoeconomic earthquake did not happen in a vacuum. Intelligence rapidly surfaced indicating highly coordinated back-channel diplomacy between Ottawa and Brussels in the weeks preceding the shock. The European Commission has publicly signaled its intent to accelerate structural integration with the Canadian market, viewing it as a stable, rule-of-law alternative to an increasingly volatile United States. Simultaneously, the administration in Mexico City has begun quietly drafting parallel asymmetrical trade measures, threatening to compress the U.S. economy from both its northern and southern borders. The commodity markets reacted with violent efficiency. Benchmark crude futures gapped up significantly, and natural gas markets experienced double-digit percentage surges as the reality of supply constriction set in. Inside Washington, the political fallout has been catastrophic, with key legislative leaders privately warning of an unmitigated disaster heading into the next election cycle. Macro strategists are currently modeling three primary trajectories for the global economy over the next operational quarter. 1. The diplomatic capitulation. Washington is forced to unconditionally retract the executive tariffs in exchange for the stabilization of northern resource flows. This requires an immense political sacrifice, but prevents irreversible structural damage to the U.S. industrial base. 2. The continental fracture. Tariffs remain entrenched. The U.S. spirals into a stagflationary recession driven by immediate energy scarcity, food inflation, and massive corporate tax flight. Conversely, the northern economy rapidly rebalances, bolstered by unprecedented state infrastructure spending and exclusive European trade pacts. 3. The reserve currency erosion. Systemic horizon. The most dangerous long-term outcome. As North American trade bypasses the U.S. dollar and shifts toward euro and multi-currency settlements, global demand for the U.S. dollar structurally declines. This initiates a fatal feedback loop. Lower dollar demand yields higher U.S. Treasury borrowing costs, eventually threatening the mathematical sustainability of the U.S. national debt. Critical intelligence indicators to monitor. Watch for formal SEC filings by major tech or automotive conglomerates, citing fiduciary obligation as the legal rationale for relocating holding companies to Canadian jurisdictions. Monitor spot prices for heavy sour crude at the Cushing, Oklahoma storage hub, as well as retail diesel prices across the U.S. Midwest. Track the formal ratification of expanded zero-tariff logistics treaties between the European Parliament and Ottawa. The era of unilateral tariff imposition without consequence is functionally over. The global economy is too intertwined, and sovereign states have learned how to weaponize the very capitalist structures the United States helped build.